The Great Depression, Central Banks, BIS, and Policy Dynamics. 1. Proliferation of central banks. By the early 20th century, a limited roster of central banks expanded rapidly following the 1922 Genoa Conference, where delegates urged universal adoption of independent reserve banks. The stated objectives were stability and coordination. The practical effect was concentration of monetary power at arm's length from democratic oversight. As any contracts professor might quip, always read the indemnities and the immunities. Footnote. The Genoa program normalized central bank independence, prioritizing technocracy over parliamentary control. 2. The Bank for International Settlements, BIS. Founded in 1930, the BIS reoriented from reparations clearing to permanent coordination among central banks, operating under treaty-grade immunities, secret bimonthly meetings, and archival inviolability. In practice, it functions as a club of monetary authorities with private law protections. Think of it as the faculty lounge of global liquidity, minus the minutes. Footnote. BIS structure embeds supranational monetary governance insulated from domestic legal process. 3. U.S. Federal Reserve Policy, 1920 to 1929. Post-World War I deflation was administered via sharp rate hikes and balance sheet contraction, discount to 9%, reserve asset sales, precipitating agricultural collapse and bank distress, 1920 to 1921. A policy pivot in 1927, broad easing in securities purchases, fueled credit into equities, elevating valuations far above fundamentals. Monetary doctrine oscillated, price stability did not. Footnote. Alternating monetary brakes and accelerators redistributed losses, farm/rural, and gains, financial centers. 4. 1929 market break, mechanics, not mystique. In 1929 the Federal Reserve tightened, rate to 6%, brokers' loans were curtailed, and sell at market cascades met thin liquidity, producing a classic leverage unwind. By 1932, listed equity values fell 83%, credit intermediation ceased, and procyclical margining amplified the drawdown. Efficient markets looked less like law and more like physics. Unforgiving physics. Footnote. Leverage plus abrupt liquidity withdrawal transformed correction into systemic deleverage in. 5. Real economy consequences. Roughly 10,000 banks failed, 200,000 firms shuttered, unemployment peaked near 1 in 4 workers, and national income contracted over 40%. Price deflation, income collapse, and debt overhang formed a self-reinforcing triad, a reminder that liquidationism is not a growth strategy, except for scrap dealers. Footnote. Debt deflation dynamics. Falling prices raising real debt burdens, entrenched contraction. 6. Congressional critique as primary source. Contemporaneous speeches, for example, Representative Louis T. McFadden, 1932, attacked the Federal Reserve's legal design, independence, and crisis conduct, urging a return to a treasury-centric system and strict separation of bank and state. Whatever one's view, the record evidences durable constitutional tension over delegating currency powers to semi-private entities. The footnote writing is easier than the institutional reform. Footnote. Congressional debates document persistent constitutional objections to delegated monetary sovereignty. 7. Douglas's social credit, a consumer side fix. Engineer C.H. Douglas argued aggregate prices routinely exceed aggregate incomes, A plus B theorem, proposing state issuance, a universal national dividend, and a just price adjustment to pass productivity gains to consumers. He anticipated technological unemployment and rejected tax-funded redistribution in favor of monetary redesign. Central banks, unsurprisingly, were not amused. Footnote. Social credit reframed underconsumption as a monetary accounting flaw rather than moral failure. 8. Irving Fisher and the Chicago Plan. Yale economist Irving Fisher advanced 100% reserve banking, Government issues money, banks lend time deposits, not demand deposits. Predicted outcomes: end of bank runs, stable prices, lower public/private debt, and smoother cycles. Later IMF simulations, Benesch and Kumhoff, found the architecture theoretically delivers those results, proof that sometimes the 1930s footnotes were the right ones. Footnote: Full reserve proposals target the creation channel of money, not merely its price.